Good evening. Welcome to the 10th episode. I cannot believe it's been 10 episodes already. The 10th episode of DIY Bookkeeping. Today we are discussing assets and liabilities, their importance, and how to record them. So all of these next following episodes, including this one, we're really getting into bookkeeping and what it is and how we do it and what place everything has within bookkeeping. And I really hope that you get a lot out of this and that it really helps you run your businesses the way that I'm hoping that it will. Again, it's all for management purposes. May I remind everyone to please enable StreamYard. We do this by clicking on the three little dots at the corner of the video. And this enables StreamYard so that I can see who is commenting. Without it, it comes out as anonymous. So please enable StreamYard. I would love to see who all is making any comments. So I always in the beginning, go over why I do this. It's a reminder to everyone, a good reminder that we need to pay it forward. And I just pray that you get you get a lot of everything that you need out of all of these series. I do this for the small business owners that may not be able to afford bookkeeping. And just because you can't afford a bookkeeper does not mean you should be failing. Your business finances should not fail. These are for management purposes only, so that you can see what the financial health of your business is. You need to know whether you're making a profit or if you have a loss. You need to know how much you're bringing in revenue and how much you're spending in expenses. It's not good enough to look at your bank account and say, yes, I've got money in it. That doesn't work. Trust me, I know. This does not work. And a lot of other business owners would say that the exact same thing. So please don't ever do that. Please do not go out there and try to get a $5 million loan so that you can get yourself a Lamborghini, a new house, or expand your business. That's not what this series is all about. That's not what this is for. This is so that you can see what your financial health is for management only. So we always go into a review. So let's review a little bit. So yesterday we talked about the introduction to QuickBooks Online, and we are I'm just going to give you a really quick, now you're actually going to see me and it looks really weird. Okay, so remember, we went over the dashboard here. We went over the invoices, expenses, your bank accounts, the fact that QuickBooks Online has a bank feed that brings over every single transaction from whatever accounts that you actually put up there. It also goes over your profit and loss and your sales. And remember, we also discussed that this widget board can be changed. So you can actually add widgets. We went over the banking and the fact that this is your bank feed, what we were talking about, matching, adding, viewing, recording transfers, things like that. We went a little bit over the rules, not too much. That's more of an advanced feature. This is just for the beginners. Receipts, we went over receipts and we talked about what the benefit is of having QuickBooks Online and the fact that you can just take a snapshot with your phone of a receipt and you can upload it directly into QuickBooks. You can either change it in here so that you know exactly where you can put it, or you can actually do it from your phone, and which is such a handy feature. We went over expenses, overtime activity, the fact that you can actually put your timesheets in here, especially if you're a service-based company like myself. You can add bills in here from your expenses, from your vendors. You can add expenses. This is not a bill. Basically, adding an expense would be like adding a credit card expense. You enter your checks, purchase orders if you deal with them, a vendor credit. So if you return something from Home Depot, then they're going to give you a credit. That's what this is. And paying down a credit card, remember, paying down a credit card is different than writing a check to the credit card. This is a much, much easier way. And this is a brand new feature of QuickBooks Online just this year. And we discussed sales. Your overview screen that shows you a little bit of what you're doing here, all of the invoices that are due, past due, have not been paid. Your sales that shows every single invoice that you have sent out, and it's not in any particular order other than the fact that, well, no, it's not even in that order. We've got our invoices that shows everything that we have invoiced out. It gives us a status report for everything, tells us whether or not it's overdue, whether we need to receive a payment or not. And that is all by vendor. You can actually sort all of these. And then your customer listing. We also discussed that you can click on here to get to the invoices, but you can also click on there in order to change the customer details. So if they've moved, you want to change their address. And we discussed the products and services. This is everything that you sell, whether it's a service or a product, it all goes here so that when you do send out those invoices, these are the things that you're going to charge them. And we had discussed projects, and I forgot that this is something that's not set up because this is a sample company. The projects is basically your sub-accounts. It's when you have a customer that has, for construction, for instance, you have a customer that's got multiple job sites. Those are the projects, also known as jobs in QuickBooks Desktop, if you're familiar with that part of the software. We didn't have time to go over the rest of these. We will be going over them more in time. I did show you just before we left just another quick view of the profit and loss because I was tying this to the dashboard. And remember, you've got your income minus your cost of goods sold to get your net income, minus your expenses to get your net revenue, minus your expenses to get your net income. If you have a net income, then it means that you are in the black, which is good. If you're having a net loss, not so good. You're in the red, you're in the negative. Okay. So now we're going to get into the meat and potatoes. So I hope that you get your notepads ready. We are going to dive into assets and liabilities. So assets and liabilities, their importance and how to record them. What is an asset? An asset is a useful or valuable thing, person, or quality. It's something that you own. Examples would be vehicle, equipment, building, land. Pretty simple. It's anything that's going to increase your net worth. Why are they so important? Because they can help you to generate revenue increase your business's value, as I just stated, facilitate the running of your business, and they can even help you achieve potential savings. And when I say that, I mean it gives you that broader picture so that you can figure out whether you want to purchase a vehicle versus leasing a vehicle. So it's kind of, your choice. But sorry, I'm a little bit scatterbrained right now. I've been so busy today trying to roll something out for tomorrow. Once you have all of this down and you are reporting everything the way that you should for management purposes, once you go into your balance sheet, and I'm going to show this to you in a little while, once you go into that, and once you see the big picture of everything that we're talking about, you'll be able to understand and you'll be able to make those decisions based off of how much money it's going to save you. So, what is depreciation? What gets depreciated and why? So depreciation is the reduction in value of an asset with the passage of time due in particular to wear and tear. So what gets depreciated? Vehicles, building, and equipment. Land does not get depreciated because it's hard to put a value on land and improvements. The IRS does not look at land as a depreciable item. So its value always remains the same. So a building falls apart over time. A building needs to be repaired over time, gets improvements, gets add-ons, gets construction done. Land, it doesn't get that. Yes, you can build something on land, but it's not the same because the only maintenance that land is going to get is landscaping. So, and landscaping does not get depreciated either. It's not an asset. Why do they get depreciated? Because over years, assets get depleted. They begin to fall apart due to wear and tear. And eventually, they're going to reach the end of their useful life. So the IRS determines how long something can be depreciated for. So if it's a building, it kind of depends how you want to take it. It can be 30 years. It can be 35 years. I know that there are some other things that I'm not even privy to that where you can actually take depreciation in a much shorter time frame. And there are experts out there that deal with this all the time. I am not one of them by far. So how do assets get recorded? So let's go back to QuickBooks and we're going to show you. So your assets are typically, well, the best way to record them is going to be in your chart of accounts initially, and only initially. So you see, when you add something, let's say you've just purchased a new vehicle and you need to add the vehicle to your chart of accounts so that you're always able to record everything on it. You're able to record your depreciation. You're able to record the original cost. What we do with all of these is journal entries, but for the sake of this, for right now, it is just the chart of accounts. What we're doing is we're entering the opening balance. And there's something called an opening balance equity, which is an equity account. But here, we've got vehicles. Now, right here, you're going to enter the make and model of the vehicle, the make, model, and year. You can put a description in here if you want. If you have a lengthy list of vehicles, you can actually check that this is a sub-account. You might have a heading that just says vehicles, and you want everything to be totaled under that. So that's when you would want to create a sub-account. Then you're going to say here, I want to track the depreciation. You're going to enter the original cost. So let's say that you paid $53,000 for it, and you purchased it as of today. Then you're not going to enter any depreciation for now, but you will. And so if we were to actually change the date, let's say that you purchased it 3 months ago, so 9/10. Depreciation is going to be based off of what the IRS says that you can take, based off of the amount of years or the period of time. So let's just say you're taking, we're just going to take a random number here. I'm not going to do any calculating for you. It's going to take too long. So let's just say that you're depreciating it at a cost of $800. We're just going to say $800 a month. You purchased it 3 months ago. You're going to start depreciating it the next month. So that is $1,600. That is actually, we're going to put the 800 in, and this is going to be as of 10/20. And then you're going to hit save and close and see what that has done right here. It has created your depreciation. It's created your original cost. It created the vehicle. So you have your total cost, you have your depreciation, and now you have what's left. And every single month, a new journal entry is going to have to be put in. I would highly recommend getting a CPA for this if you can. Or a bookkeeper, even just to keep track of depreciation. But we're also, let's see here, we're also going to go over, we're not going to go over inventory. That's a little too advanced right now. Let's go on ahead and add another one. This one's going to be an other asset. Let's say you've got organizational costs. We're not going to depreciate that because let's just say that, yeah, actually, let's do security deposits. We're not going to depreciate security deposits because you can't depreciate it. It's not your money. So it's in the system. All you have to do now is just record the entry. So, and I know we're going to go into journal entries here, and this is advanced, so keep your eyes peeled. They always say, if you're going to do journal entries and you're inexperienced, you shouldn't be doing journal entries. These are for people that know what they're doing, know how to handle everything, all of the bookkeeping and the accounting. So let's say that you, okay, where is it? We entered the organizational costs. And for some reason, it's not showing here. So you know what? Let's just put in prepaid expenses. Rule of thumb is for assets, it's a little bit different. When you think of a bank account, you think that increasing it is going to be a credit, debiting is going to be subtracting. It's not that way. It looks that way on a bank register, right? So when you're actually doing a journal entry, it's completely the opposite. It's strange. It's the opposite of what you would think. So we're going to increase our prepaid expenses. So let's say 1,000, and to increase prepaid expenses for 2020. And then we're going to debit checking. This is a journal entry. And then we're going to save and close. So now when we go to prepaid expenses, and of course it went and did the exact opposite on me, which is strange because an asset always, come on. An asset always gets increased by, you know what I did? I put it in as a credit exactly the way that I said not to do it. Okay, so now you go, I told you today's been a long, long day. So now you go to prepaid expenses and you've got $1,000 in there. So now every single month you're going to take a portion of that and you're going to deduct it from the prepaid expenses. So then that balance will always go down. Normally with an asset, the balance will remain the same normally, unless you're depreciating it. I know this is just a really quick and dirty lesson, and I wish that we had more time, but we don't. So let's go over liabilities. What is a liability? It's a thing for which someone is responsible, especially a debt or financial obligation. Examples are credit cards, loans, credit lines, and vendor payments on account. However, credit cards and credit lines are recorded a little bit differently. So when I say vendor payments on account, we're not talking about paying someone cash. We're talking about paying someone on an account that you set up. Let's say that you go to Home Depot and you, instead of getting a Home Depot card, they actually have an account that you can open through them. So they're always going to send you an invoice. Actually, a really good example is Central Valley. I don't know if you've ever heard of Central Valley or not, but Central Valley is another building supply store. And they're one of Home Depot's competitors. And they actually have purchases on account. So when you go to pick up your roofing tiles or whatever, you just give them the name of the company. They'll ask you, is there a job that you want to put this under? You give them the property address and the owner gets the bill. Excuse me. So that is on account. Why are liabilities so important? Companies use liability accounts to maintain a record of unpaid balances, to unpaid balances of okay. I am so sorry, guys. This isn't like me. It's to maintain a record of unpaid balances to vendors, customers, and employees. As part of the balance sheet, it gives shareholders or owners, same thing, an idea of the health of the company. Liabilities represent an important aspect of supply and demand in the economy. How does a liability get recorded? Okay, so back to the chart of accounts. We're going to show you the liabilities right here. We've got credit cards. We've got revenue payable. We've got Board of Equalization, loan payable, and notes payable. So there's not a whole lot of difference between a loan payable and a notes payable. What the difference is right here. If you remember correctly, back closer to the beginning of when we started this series, an other current liability for a loan may be a personal loan that you receive from, let's say, your boss because you had 4 flat tires, someone slit your tires, whatever. And you have no way of getting to work. So your boss loans you the money. So he may charge you interest, he might not, but it's going to be something much, much lower in value, something that you're going to pay off a lot quicker. A notes payable for a long-term liability is going to be the note on a car, the note on a house or on a building. The value is going to be much, much higher than what this is. So essentially, to create, we're not going to do loans right now. We're actually going to concentrate on credit cards just because they're pretty easy to do. So we want to come back up here to expenses. And we are going to go to expense. We're not going to go to bill because we haven't received a bill, and it has to be recorded differently because getting a bill from someone would imply that you're actually going to pay for it through your checking account. That's not the case here. So for your credit card, we're just going to put in Bob's Burger Joint. Sure, why not? And remember, these are the expenses that you actually paid out of the credit card. This is not paying on the credit card, not yet. So we're not going to choose checking. We're going to choose one of the credit cards. So let's just say MasterCard. You want to make sure that your date is correct. Of course, credit card is going to be the correct thing. I like to put a reference number in there. Your credit card receipt, or not the receipt, your credit card statement is actually going to have a reference number typically. I like to put that in there because if you have to contact the credit card company, that is a very helpful item. And then down here, and by the way, I don't do anything with tags. That is something that's brand new. Your category, that is going to be whatever the expense was. So Bob's Burger Joint, you can pretty much figure that that was meals and entertainment. You can put down a description here if you'd like, and the amount is going to be, I don't know, $15. I hope you don't bill this to your customers, but if this was a credit card expense for Home Depot, Central Valley, any other supply store that you would have to get your building supplies from, or even if it was a QuickBooks Online subscription or something that you are specifically billing your client for, then you would choose billable and you would find the customer. And then of course you have the ability to charge tax. So then you save and close. Now, let's say that you've got 10 expenses, even though you probably don't, not in this one, in here in order to pay your bill. So now you're going to pay down your credit card. We're going to choose the MasterCard. Payee is going to be typically you, really. We're just going to say $15 because that's what we just put in there. Payment date. And then which account you're going to pay it from. We're going to choose checking, save and close. That's it for paying a credit card. So it's fairly easy to keep track of your liabilities. It's a lot easier to keep track of your liabilities than it is to keep track of your assets. The assets actually require, as I said, journal entries, liabilities not so much. However, when it comes to loans, things do have to be broken down, and that could require it could require a journal entry depending on how you do it. So I know, like I said, this isn't definitely this video wasn't up to snuff. Not the way I try to do them, and today has just been wild and crazy, and I'm I am going to try my best going forward to never allow this to happen again. But I just hope that you learned something from this. Again, you always, always, always can reach out to me. I'm on Facebook. You can reach out to me at Miss Elsie's Bookkeeping LLC. And go on ahead and send me a message, and I will do my best to answer it. And you can also send me an email. Look me up on Facebook and you'll be able to find me. Just contact me through there and I will be available for you. So please ask all the questions that you need in order to accomplish what it is that you're going through. So next week, let me pull up my schedule here. Next week, we are going to resume on Tuesday. And sorry, folks, my computer has been taking a while lately. Come on. Thank you. So next week, we're going to be discussing cost of goods sold and expenses / prepaid expenses. We already went through that a little bit today. And what's the difference? That is on Tuesday. Wednesday, we'll be going over income and owner's equity. And Thursday, the 17th, we'll be going over reporting for the profit and loss and the balance sheet, what they are, what the differences are, and what goes on them. And we will not be having anything the week after that because that is the week of Christmas or the week after Christmas and New Year's. So we won't be having any videos at all for 2 weeks. So tune in next Tuesday, Wednesday, and Thursday to get your DIY bookkeeping fix. And I pray that all of you have a wonderful weekend and stay safe out there. Thank you for joining me.